Welcome back to Fast Money. A record day on Wall Street. The S&P 500 and NASDAQ notching record closes as earnings season reaches a fever pitch and the Fed gets ready to meet. But Morgan Stanley sees trouble ahead. Chief U.S. strategist Mike Wilson is predicting the S&P will tumble 10 to 20% in the next 3 months. Mike joins us now. Mike, great to have you with us.
Great. Thank you for having me.
You've been cautious for a while, and you say that you've been getting it wrong. What makes you think that this time around the correction is actually going to happen?
Yeah, well, look, I think there is a correction going on under the surface, right? So the S&P 500 has not really corrected at all. In fact, it's making new highs every day. But we have had a correction in first the expensive stocks, when the rates went up, and then we had one in small caps. So it's kind of under the surface, we're seeing a rotation towards quality, and that's really been our call since early March. And, the S&P 500 is the quality index of choice. So that kind of makes sense. Now, it's gone further than I would have guessed. But we're right on that line. Where it probably starts to spill over now into the quality stock. So what are we worried about? Really, first one is seasonal. Seasonalities are difficult as you go into May. Everybody knows that. The second thing I would say is that we got peak rate of change on virtually everything that we follow, and we think we are kind of moving into what we call this mid-cycle transition. That's faster than normal, Melissa. Normally, it takes about 2 years for that to happen, but this recovery is happening so quickly that that's happening now. So I'll give you the years. When we had a mid-cycle transition, it's 94, 04, and 2011. And all three of those years saw about a 10 to 20% correction. So that's no guarantee that that's what's going to happen, but that's what we expect. Multiples should come down. And by the way, that's what should happen at this stage of any bull market in a recovery from a recession.
10 to 20% within the next few months. Is there a place to hide, so to speak, if it's going to also hit the high-quality names?
Yeah, so I think, the high quality names should go down less, right? So in other words, it doesn't have to be 10 to 20% for everything. And by the way, we've already had a bit of a rolling correction in certain things. So it's interesting, we're trying to differentiate. The biggest risk we see is kind of in the reopening itself, right? So the reopening stocks, tremendous opportunities reopen the economy, but there's cost issues now. Everybody's finally figuring out that reopening an economy is more difficult than shutting it down. And a lot of the reopening stocks, quite frankly, have cost issues, supply chain issues, labor availability, and things like that. So we want to separate sort of the reflation trades, things like materials and financials and maybe some of the commodity areas. They probably hold up a little bit better, ironically, because the longer term story is quite good there. The other thing I would say is that, defensive stocks will obviously hold up better. So healthcare is an area that we prefer within the defensive cohort.
Hey, Mike, it's Dan. Hey, so Jim Cramer had a really interesting tweet this morning saying that many of the forecasters he watches thinks that we're at a peak economy, and therefore, if that's the case, then Jay Powell would be right to keep rates lower and keep his foot on the pedal. What do you make of that, and how do you think the Fed plays into this call that you have?
Yeah, I'm not really anticipating anything from the Fed that's different than what they've been saying. I suspect they're going to be very dovish at this meeting. They're going to continue to put their foot on the pedal, as you say. I think that's their job right now, is to make sure that we get to the other side of the virus and people are vaccinated and we can actually reopen. They're going to wait to see the whites of the eyes of that recovery. So I don't think the Fed is really part of this particular correction if we're going to get one. However, the peak rate of change is going to play into the market's anticipation that the Fed's next move will be a tightening. I think it's hard to argue they're going to do more. So whether that's in June or in Jackson Hole, they start talking about tapering or what their plan is to kind of exit this extraordinary monetary policy, that is probably sometime in the next 6 months. And the market, being a discounting machine, will start to think about it. But I don't anticipate the Fed doing anything proactive in that regard.
Hey, Mike, it's Karen. So I read your notes, and you talk about equity risk premium contraction sort of being at probably the bottom. Even if the Fed keeps their position, is it possible that we just see the market move rates enough that causes the contraction you're talking about? That causes the correction you're talking about.
Yeah, that's right, Karen. You can get a multiple contraction, a couple different ways. Equity risk premium, blows out, or rates go up. We got that in the first quarter, as you know. That was really our call back in January, that the expensive, long duration stocks would get hit as rates went up. So that adjustment has happened. And then, what's interesting to me is that, those stocks really have not rebounded. A lot of those stocks are still down 20 or 30% because they were just too expensive for where rates are now. I do think the next adjustment will come through the equity risk premium channel as opposed to the rate side, because look, equity risk premium at 280, 285 is too low. given this reopening risk that we see, the Fed's next move being somewhat of a tightening, and something we haven't even talked about yet is taxes and some of these maybe less friendly things that are going to happen next year.
All right, Mike, we're going to leave it there. Thanks so much. Mike Wilson of Morgan Stanley. Karen, just to follow up on the question you asked Mike, how are you starting to think about valuations?
Nervous, pretty nervous. I mean, I want to own protection here with the VIX, lower. I don't like to sell what I own, but I do need more protection. I feel like inflation's here. Rates are going higher.
When I hear Mike talking about the Fed not doing anything and remaining dovish, Karen talking about rates can go higher anyway, no matter what the Fed does. I also think about the Fed being dovish guy, which could actually mean inflation gets hotter, and that's bad for the markets, particularly when the markets are starting to factor in a tapering of the Fed's bond purchasing program before the end of the year, or at least telegraphing of that. How do you put all this together?
Well, I've been trying to put that together for quite some time, and every time I sort of connect those dots, it leads me to believe we're going to have the scenario that Mike Wilson just talked about, and it's been the incorrect one. But I'll say this in terms of what Mike pointed out. It's very similar to what Savita from Bank of America pointed out a week and a half or 2 weeks ago. I'm not saying, I'm just saying the thought process is very similar. And oh, by the way, Tony Dwyer, who came out, I think, last week, said similar things as well. So you have some very well-heeled analysts making similar comments as to what they're seeing out there. Again, none of them said they can time this thing. Clearly, I haven't been able to, but the warning signs are absolutely there.
We've got Tony Dwyer joining us tomorrow, actually, so we'll check in with him on his call. Speak of the devil. Delano, how are you feeling? Because now that more strategists are moving to the cautious side of things, do you feel like maybe you're more emboldened to remain long?
Yeah, Melissa, I haven't really taken risk off, but I've been diversified. And it was mentioned there's a couple areas and pockets where investors can look to be defensive. And I think healthcare is one of the areas where investors can make sure that they're defensive. And also, the cyclical reflation trade is obviously an option as well. But, being diversified in the situation is probably the best bet. Obviously, I love being long some of the growth and mega cap stocks, but diversification for myself and for investors is going to be the best play in the case of anything, with the market happens.
Shepard Smith here. Thanks for watching CNBC on YouTube.